Hi, everyone. One question that Andrew and I get often is, how do you prioritize which accounts to save in? There are many different account types out there, from retirement accounts to accounts that help you save for medical expenses, kids' education, just a future goal that might happen 2 years from now. You're putting a down payment on a house. There's a lot to consider, and in some ways, there are some basics like make sure you're doing this and this before you start setting money aside. But then also, as you kind of progress through some of the basics, what's the next place that you'll maximize your savings dollars? So we wanted to go through a little bit today, just some thoughts we have. Certainly, this is not the formula that we recommend for everybody because everybody's situation is going to be a little bit different. But we wanted to share some thoughts to try to help you get thinking and decide what's best for your priorities.
Yes, as John said, there are many different types of accounts and I think we're going to throw up something here. There's money markets, bank accounts, high yield savings accounts, and CDs, right? So really taking no risk there, keeping your liquid cash in those types of accounts. Now, recently, really over the past 2 years, you've finally been able to earn a decent interest rate on your cash. So we're always encouraging clients, if you're making nothing at the bank, there's a money market, the one we use is yielding 5+%. Let's take a look at what's going to maximize your risk-free earnings. Retirement accounts at work, or if you're self-employed, right? So, everyone knows the 401k, but if you're self-employed, there's individual 401ks, SEP IRAs. There's also individual retirement accounts, IRA, and then also Roth IRA, first being pre-tax, the Roth being after-tax, and growing tax-free, withdrawals tax-free.
That's a whole other conversation too, about whether you want to do the pre-tax or after-tax. So
yes.
In some ways we're talking about just, the order of the accounts.
Just dollars. Yes, not the intricacies of the tax advantages. HSA being the health savings account, which we love. It's a great tool. You have to be eligible to contribute to it, but it's really the only type of account where you get tax deduction on the front end, grows tax-free, withdrawals are tax-free if used for medical. And then just a normal brokerage account, right? So you want to invest dollars, in stocks or bonds, whatever it is, but have no retirement restrictions. That's another great investment savings vehicle. And then we'll also touch on briefly children's savings accounts, right? So we encourage younger clients, when they start having kids, get your legal documents, get enough life insurance, and open that education account as soon as you have a Social Security number, because you're going to need it over the next 18 to 22 years. So we've kind of got a list of how we would recommend prioritizing putting your dollars into these different buckets. Now, one caveat is it doesn't have to be, okay, I got to do number one all the way, check, before I go to number two, or 3 to 4. You can always parcel out your dollars so that you're hitting several of these goals at the same time. But in terms of where to start, this is kind of a basic list that we came up with.
Step one is an emergency fund. If you don't have any extra cash in the bank for unexpected expenses, the car is going to need maintenance, air conditioning is going to go out, things like that. Putting your money into a retirement account could actually somewhat shoot you in the foot, because you'll be penalized for taking it back out when you need that money. So you first need to build up just a cushion. It's referred to as an emergency fund, just a cash savings. Sometimes people just do that as pure cash in the bank or a money market. Other people might look at it as conservative investments in a brokerage account. So you've got to decide what's right for you. But the bottom line is, where can you access some money relatively quickly, and it's not going to be subject to, hey, the stock market is down 20% in the last 3 months, because that happens. We've been seeing that a lot over the last couple of years.
Yes, and again, if you are going to keep it at the bank, use a high yield savings account, right? It can be FDIC insured, but there's online banks paying 4 to 5%. So don't let the bank win. You win on that cash you're going to leave liquid. Just as important, and it's almost side by side with these, I would say, make sure to contribute to that emergency fund. How much to keep, 3 to 6 months? It kind of depends on job security. If you plan on switching jobs, do you have big upcoming expenses? You may want to hold more cash. But the other being bad debt. So we would characterize that as credit cards, especially, well, always, but especially right now, those credit card interest rates are at their historical highest. I think the average is 22 to 25% interest. So if you're carrying a balance, that's a huge dollar amount going to the credit card company and not into your pocket, and you're really not paying down that balance. If you have unsecured personal loans at high rates, if you owe to the IRS, any other high interest rate debt, chip away at that. And there are different ways to attack that debt. There's kind of a snowball method. There's looking at the highest interest rate, but have a debt plan. So you want to eliminate all bad debt. What's good debt? Maybe a low fixed rate mortgage, a low interest rate auto loan, student loans that will get you higher paying jobs at some point. But attack those two things, build up some cash and also eliminate that bad debt.
So yeah, once you have some money set aside for emergencies and you've attacked your bad debt, we typically want to look at people's retirement accounts through work, because often there's some incentive if you will save there. So that's the company match. So if a lot of employers, if you contribute 3%, 4%, 5% of your income, they'll match it. And there's usually a formula. Some of them it's pretty straightforward, like 100% up to 3%. So you put in 3%, they match it 3% as well. Other formulas might be 50% on the first 6%. Well, what does that mean? Well, that means you have to put in 6% and they'll match that 6%, but only 50 cents on the dollar. So you essentially get 3% match that way. But you have to do the full 6% to get that 3%. If you only did 4%, they'd only be matching 2%. So you got to know how the math works there. But yeah, those the free money is there. There's not many investments out there that offer 100% return. Make sure you're taking advantage of that.
There's also other benefits. You want to look at your employer benefits every year, and we're happy to do so with you. But if they potentially make a HSA contribution on your behalf, if there's an employee stock purchase plan to where you can buy company stock at a discount, what are all the things available to you? A dependent care flexible savings account, so you can pay for education with pre-tax dollars. You want to make sure you're maximizing all the benefits.
Some are offering student loan matches now, where if you contribute to your retirement account, they'll pay off your student loan as the match. So that's kind of been an interesting new thing.
Yeah. Touched on the HSA briefly, but the health savings account is a way to save for healthcare expenses if you have a high deductible health plan. So if you're paying a low premium but you have a high deductible and max out of pocket, you're likely eligible for an HSA. And if you are, we very much encourage you to contribute. You usually have till April 15th of the following year to contribute for the prior year, and you get a tax break on it. And there's no income limitations on that. So the limits for 2024 are $4,150 if you're an individual, $8,300 for couples, and then if you're over 55 years old, you get to contribute an additional $1,000 to your HSA. The last thing I'll say is if you don't use it, which is great, right? You just are basically building up another retirement savings account, really for healthcare expenses that's tax-free. But if you don't plan on using it, a lot of those HSA plans, you can invest the dollars within. So they have investment options, just like in a 401k, to where you're saying, okay, I want to take lower risk, higher risk on this because I don't intend to use it for many years to come.
Well, and with an HSA, we're all going to run into unexpected medical expenses. I just turned 40, and I've been surprised at how many of those I've had over the last couple of years. If you're going to start a family and pay for a delivery cost, that is not cheap. So I was so glad for my HSA at that point. But the HSA, it's another way to think about it is you're getting a discount on your medical expenses, because if you put in $1,000 and that saved you, say, $220 or $240 of income tax, well, that $1,000 medical bill that you get to cover really only cost you, $760 $60 out of pocket. So it's it's something that you may utilize before retirement. But as Andrew said, once you turn 65, you can actually use it for anything, even if it's not a qualified medical expense. Now, what happens is the earnings, if you pull money out of an HSA at that point, you have to pay income tax on, but that's literally the same as how like a pre-tax 401k works.
Yeah. I had a client I saw the other day, we're working on his plan, had a $250,000 HSA.
Oh, man.
Not to say that everyone will get there, but what a wonderful way to pay for a large portion of his healthcare expenses in retirement that just saved along the way and invested to get there.
And we kind of kick back and forth whether an HSA or a Roth IRA is kind of the next best step. But yeah, or a traditional IRA, just kind of a retirement account outside of your company's retirement account. So again, some of this may be, hey, you've got your emergency fund, you don't have bad debt, you're getting your match. Maybe you put a couple $100s a month into an HSA and a couple $100s a month into a Roth, and you're kind of building both simultaneously. Because they, kind of have different purposes and what their benefits are. So, but that's, the HSA and the Roth, those are kind of our next favorites. We, for an individual in 2024, you can do $7,000 to a Roth, or really a Roth or an IRA, but you've got to understand the caveats that go around with it, because a traditional IRA, that's a pre-tax, a lot of people get to deduct that on their return, but if you're participating in your company's retirement account and your income exceeds a certain level, you may not get that tax deduction, even though you can still put the money into the account. Or a Roth actually has a phase out where you just can't contribute to it at all. Once you're making over a certain amount, and the limits are different if you're single or married filing joint. There are some strategies around that, but it's just one of those things, especially if you're young and your income is lower, you don't want to miss those Roth years because you might end up not being able to contribute to them down the road.
Yeah, forego the tax savings to get tax-free growth and then tax-free withdrawals and all the compounding in those years. That's also, that's a little pitch to watch our was it Backdoor Roth conversion video.
That's right.
So go to our YouTube page and you can catch up on all the nuances of that. So let's say you've done everything we've talked to this point, and you're still, have the ability to and want to be aggressive about your savings. Then you're looking at, going back to the 401k. Okay, how can I max this? And the great thing about maxing out your 401k is once you get to that point, you really will likely do it for the rest of your working career, because it increases a little bit each year. But if your income is also increasing, you shouldn't have a problem maxing it out. It shouldn't affect your cash flow. So for 2024, the max 401k contribution for an employee is $23,000. And then if you're over 50, it's $30,500. So you get to do an extra $7,500. Now, as to whether to do a Roth contribution to a 401k or a traditional contribution to a 401k, it can, that's where we want to sit down and talk about it, because it depends on your tax bracket. It depends on assumptions on future tax rates. It depends on, tax savings. So the bigger thing is knowing those limits that you can get to, and hopefully you're just using each of these buckets to maximize your savings.
Well, and some people, frankly, may not want to max out their 401k if they've got different investment priorities. I've had some clients that really were interested in buying, rental properties. So if you put all your money into your 401k, well, you can't buy a rental property inside of a 401k. You might have locked that money up and you can't really utilize it. There are some ways you can do that in an IRA. They get a little bit complicated to do so, but that's a consideration too. It's just am I really wanting to commit that maximum dollar amount to a 401k? I mean, we love it from a financial planning standpoint because there's only one way to pay for retirement. I mean, Social Security doesn't cover but maybe a third of the average person's expenses. And the sooner you do it, the better. So it's like, the sooner you get a jump start on it, the less you have to save in the long run. But there still could be some arguments as to why you don't want to lock all that money up inside of a 401k. Kind of a last option is just doing an individual or joint account. I mean, you can buy the same investments, it just doesn't come with the same tax benefits like growing tax deferred or tax free. At the same time, it's money that's accessible to you before you're 59 and a half. You can use it anytime. You know, if you're buying a new house or a car or whatever, it's money that you can get back without a whole lot of tax consequences. So again, that's why we say this list is just kind of a general guideline, but your personal situation may be a little bit different in how you prioritize things. So
yeah, and we call this "Where Should My Next Dollar Go?" because you know, these recommendations are also to help you avoid lifestyle creep. You know, if your income keeps going up, but you are only doing the, you know, enough in the 401k to get the match and a little bit into an HSA, you're likely spending the rest of it, right? So if you can kind of go one after the other, it makes sure you keep pace with your increased income with these different ways to save. So, you know, the other thing is, as your income gets higher, your savings rate, you may need to get more aggressive on it because your lifestyle that you're accustomed to is probably more expensive. So you need to be saving more dollars now during your working years to be able to keep a similar lifestyle in your retirement years. And lastly, another one, especially for when you have children, we touched on education accounts, 529 college savings plans, custodial accounts. That's another important one to add to that list. You know, this doesn't apply to every person, right? So it's based on your situation, but that's another large expense that you will have. Better to save along the way and take advantage of, you know, compound growth than child turns 18, goes to an expensive college, and now you're looking at, okay, how do I come up with the money for that?
just take on a lot of student loan debt that is expensive. So
Yeah.
but yeah, we were going to do just, I don't know, kind of an example here. If we had a married client and say the, you know, household income was $150,000, well, from our standpoint, you really need to be trying to save 15% of your income. That's just a good solid number that will set you up for the long run.
As a starting point.
As a starting point.
Maybe a goal to get to, but then a goal to jump off of.
And yeah, everybody may not be able to start there. So, you know, at least try to do 10%, but then as your income grows, you can increase it a little bit each year and try to quickly get to 15%. But yeah, for $150,000, 15% would be $22,500. So Andrew, how do you prioritize where you're going to save that $22,500 if that's kind of all you have to save?
Yeah, and we'll assume in this scenario, this couple already has an emergency fund. They've got, you know, 3 to 6 months of expenses liquid. They've eliminated all bad debts, and now they're saying, okay, how do I maximize this 15%? Going back, we'd say, number one, get all of that free money from your 401k from the employer. So let's assume there's a 4% match on their plan. If then they want to do 4%, that comes out to $6,000. Okay, so you're putting in $6,000, your company's putting in $6,000. Then let's assume they have a health savings account because they're on a high deductible health plan. They could do up to $8,300 into the HSA. And then we kind of talked about if you also did a Roth combined, they could do $14,000. Now, if you add up 6, 8,300, and 14, we're already over 15%. So this is where you have flexibility how to do this.
Yeah, I mean, this is where you've got to start making your decision on what your priorities are. But again, then hopefully every single year, you know, say you get a 5% raise, take another 2% of that and commit it to savings. You want to start building up what you're putting into your savings accounts every year. Because like Andrew said, if the 401k gets maxed, it's not going to take much more, you know, in the future to keep doing that. Maybe another $500 the next year. So building that habit, you'll get to where you aren't missing that money. And we just encourage everybody every year kind of keep eking up those contributions until you're doing all of your 401k, all of the HSA, hopefully all the Roth IRA, and hopefully still have maybe some dollars at some point to put towards other goals or children's education accounts.
Yeah, and last thought is, in terms of savings, I would think about it as a percentage, not a dollar amount, right? Because if you have a percentage in mind of your gross income that's your savings, as your income goes up, that percentage will make the dollars go up, which that's going to keep you on track rather than saying, I want to save, $15,000 a year. Well, as your income goes up, that $15,000 is a much lower percentage of your overall income. So,
well, and some 401k plans will let you set it as a percentage. Others may just say $1,000, per paycheck, and you're going to have to go back and revisit that as your income goes up to adjust that amount. So,
that's right.
hope you found this helpful, just to get you thinking a little bit. Again, we'd love to meet and talk more specifically about your income, your savings, and your future goals. Thanks so much.
Thanks for watching.